Jurors in a New York court are deliberating the case of Fabrice Tor, a junior Goldman Sachs banker dubbed Fabulous Fab, who stands accused of misleading investors in a bond deal before the financial crisis. The stakes are high for the Securities and Exchange Commission, which brought the case 3 years ago, and Mr. Tor, who was then a 20-year-old banker involved in selling a mortgage product known as Abacus. The SEC alleges Mr. Tor misled investors who bought the Abacus bond because he didn't tell them that Paulson & Co., a hedge fund, helped select the portfolio and was betting against it. Over 2.5 weeks, the SEC called investors and Goldman Sachs bankers to bolster their allegations. They also focused on a series of embarrassing emails Mr. Tor sent to his then-girlfriend to suggest he knew he was selling a bond that was doomed to fail. Mr. Tor, dressed fabulously in Hermes ties, testified over several days. He began by apologizing for his thick French accent and said he never intended to mislead anybody. He told the jury he deeply regretted an email to his girlfriend saying he sold bonds to widows and orphans. His lawyers, a duo of former prosecutors, presented it as a case of government overreach and appealed to the jury that their client was made a scapegoat for the Goldman Sachs mortgage machine. The question for the jury is whether Mr. Tor misled investors. But to get there, the 5 women and 4 men need to follow the lawyers down a complicated trail into the makings of a highly complex mortgage product. During the trial, the judge pressed the lawyers for both sides to avoid using financial jargon, but they couldn't avoid saying collateralized debt obligation, or CDO. If found liable, Mr. Tor faces a censure and penalties. If the SEC loses, it will be a black eye for an agency that has already lost a string of courtroom cases related to the financial crisis, and one that has struggled to repair its reputation as a tough enforcer of Wall Street. Kara Scannell, Financial Times, New York.